Put down. Let's look into put options. The put option definition. A put option is a contract between a buyer and a seller to exchange a stock at a predetermined price and date. Predetermined price is the strike price, the date is the expiration date. The buyer has the right, but not the obligation, to sell the stock at the predetermined price and date. The seller has an obligation to buy the stock from the buyer if the buyer decides to exercise the option. Let's take a look at the summary of this. A put option. The buyer. The buyer pretty much believes that the price of the stock is going down. So the buyer has a right to sell, even though they may not even own the stock. The seller has an obligation to buy if the buyer decides to execute their option. That's part of their contract. Let's use a real world example, just like we did with the call options. We're going to look at Workhorse. Workhorse. On January 20th, 21, the time that I captured this, it was trading at $23.33. It was down 43 cents or 2%. Let's take a look at a expiration date of 19 March with a strike price of 20. We're looking at the puts options chain. Remember, a put, the buyer is saying that he sees the direction of the stock going down. In this particular case, the buyer, in order to buy this put option, have to pay $4.90 per share. Remember, one contract equals 100 shares. So one contract, that's $490. And he's planning on the stock to go down. Let's look at it from the buyer's perspective. All right, here are the pros and cons. Buyer's perspective. Bottom line, that the pros is he can generate a much greater return on investment. For example, that Workhorse strike price of 24 expiring on March 19, he paid $490 for one contract. Let's say that Workhorse, because Workhorse is a very volatile stock, let's say Workhorse drops to $14, which is very possible. The stock can only go to zero. Limited loss. The buyer only paid $490 or $4.90 per share. That's it. That's the maximum amount that the person can lose. The cons are just like on the call option. Time is the worst enemy, is the foe of the buyer. And there's a lower probability of success because there's only one way for the buyer to win, and that's for the stock to go below $24 per share. Now, let's look at it from the seller's perspective. The seller, pros are, number one, that's a way for the seller to generate some income. All right, that $4.90 or that $490 that the buyer paid for it, it goes to the seller. So the seller is going to get $490. Time is the friend of the sellers, the foe to the buyer, but the friend to the seller. There's a much higher probability of success. And the reason why is because if the stock stays at the same at $24 at the end of March, or on the 19th of March, if it stays at $24 or higher than $24, the seller wins. The option will expire worthless, and the seller doesn't have to buy it. They don't have to buy it. That $490 is theirs regardless of the fact. The cons, limited profit. It's capped. In other words, that $490 is it. That's all they can get. Another con is they're forced to buy the stock at the strike price. If, by chance, Workhorse drops to $14 and the buyer decides to exercise the right to sell that stock, the seller has to buy it at the strike price, which is $24. That's a huge con. So as you can see, There's some advantages and disadvantages for both being a buyer and a seller, regardless of whether you're going with a call option or a put option. Now, one of the things that we're going to do is we're going to also take a look in the very next video. We're going to take a look at something called leaps and how you can make money with. Hey guys, listen up. Results happen over time, not overnight. Work hard, stay consistent, and be patient. And always remember, knowledge is not power. It's the application of knowledge is power. See you guys on the next video.